This is MacroVoices with hedge fund manager Eric Townsend, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Let's come back to what's happening in the market right now, Patrick. Is this a dead cat bounce, or are we actually recovering here? Listeners, you'll find a link to the chart deck in your Research Roundup email. If you don't have a Research Roundup email, just go to our homepage, macrovoices.com, and click the red button that says Looking for the Downloads. Patrick, dead cat bounce, or is it the beginning of something bigger?
Eric, what I want to do is look on page 2 on the S&P 500, and I circled here 4 of the previous bounces we had this year, and each one of them, were anywhere from 300 to 500 S&P points in a span of a week or two. Just a very solid bounce off of a very oversold condition. Here, off of that CPI number that basically wiped out 500 points on the S&P to the downside. Here we are 3-4 days after a short-term low, and the S&P can't muster up even a half-decent reaction off of that low. So far, it's a very weak reaction, and it's not just the S&P, and this is actually what the important part that I want to highlight. So let's look on page 3 where I have the Nasdaq, and you can just see that the Nasdaq continues to remain below its May lows, not able to even have any reasonable reaction off the lows. You look at the Russell 2000 small caps after breaking to a lower low, that I wouldn't even call that a bounce. I mean, it's trading very much right in the range of its low. You then take a look on page 5 of the EURUSD when you look at European stocks that continue to just look bearish, and each rally is failing, and we're on the verge of closing at a fresh new low on the EUROSTOXX index. And then you take something like the Canadian TSX on page 6, also breaking to a lower low. The point here is that if this was a short squeeze, it's an incredibly pathetic one, and so far the bounce has been incredibly weak, and that to me is a bad sign. I mean, listen, if we see that some news catalyst come out and drive a move above 4,000 on the S&P, that may neutralize the short-term sell cycle and certainly kind of spur some buying reactions on the upside. But if the rallies continue in the next few days, or in the next few trading sessions, the way they did in the past few days, you have to consider this market still in a primary downtrend and highly vulnerable. And the one thing I wanted to just leave it with was on page 7, looking at the South Korean index, the KOSPI, and just in the last 2 weeks, we've just seen an extraordinary downdraft start, and it hasn't even bounced. It just continues to sell day after day. And so this is not about the U.S. markets. There is a global equity bear market underway, and there is broad selling right across the entire spectrum. And really, there is no reason to believe that at this moment, this is anything more than a short-term dead cat bounce. And I would remain hedged and defensive, and I wouldn't be overcommitting to the upside here. This is not, unless some sort of macro catalyst emerges that drives a trend change, you have to believe the path of least resistance is for all of these equity markets to continue to sell.
Now, Patrick, one of the most useful macro signals that we have is the U.S. dollar index. And as we've discussed at length in previous episodes of Macro Voices, the Euro-US dollar cross on page 8 is critical to that. Looks like we still are holding that previous low. We did not get a new lower low yet.
Well, exactly, but it's still actually holding its decade lows. And so while the U.S. dollar has toyed with a breakout, it's really not confirmed unless the big heavyweight in the index, the euro, makes that breakdown. But again, look at the last 5 days of the euro reaction. I mean, we're just 100 pips right off of the lows. They haven't been able to muster up any reaction at all. This is an incredibly negative chart that continues to show active distribution in a downwards channel, and the bulls don't seem to have any enthusiasm to try to put together any sort of an upwards trend reversal. And so again, we're in a situation where if this little flagging formation rolls over into next week, we might find the euro heading down to parity, and that it could be the catalyst that drives the US dollar move. And if that happens, that could really be a signal that drives that risk off impulse in equity markets. I think watching this euro is actually one of the kind of best little canary in the coal mine kind of charts to watch going into next week.
And I'll make my own prediction here on dollar parity, Patrick. As much as institutional investors like to pretend that emotions are just for retail guys and they're immune to emotions, if we get to parity on the euro, I think that's a psychological holy shit moment that's going to cause a lot of people in the institutional world to change their thinking. But we'll wait and see what happens. Let's move on to crude oil futures on page 9.
Right, and what's interesting is that obviously the selling has really intensified. I mean, the sentiment was so decisively bullish in crude oil. Everyone was on that long side, and usually that means that there's leverage being used, and there's typical margin call sequences that happen that basically wash out those that were over leveraged or weak hands. The interesting part is we're now actually approaching some very critical levels. That green zone there reflects retracement zone from the rally off of March. So if this was just a correction and will prove to be a buy on dip, then on this August contract, those previous highs should act as support going into this pocket where we are, and we should see signs of oil reversing. Now, it's not necessarily a forecast, but it's an interesting level to watch into next week, because if we see that this was just a quick washout and the buy on dip traders come right back in, if we see prices next week back to 110 or higher, and the charts turning back up, then this could have just proven to being a one great buy on dip in a primary uptrend. But you're right when you made the call saying that if there is a recession, that there could be more downside. But at this moment, this is a critical level to watch for a buy on dip, and I'm going to see whether or not it reacts off of here.
Well, I already bought this dip on this week's weakness, and I'm crossing my fingers that we're done here. But I've also made sure that my position sizing can tolerate another $10 down, because when we get the reality of recession and when the stock market turns from orderly sell-off to disorderly sell-off, it almost has to mean that crude oil futures get dragged down, at least temporarily. Longer term, though, I think we go much higher.
Eric, let's go to page 10, where I have the crack spreads, which is getting a lot of political press, obviously, in terms of gasoline prices and the profit margins. Obviously, we have seen actually decade highs in the Brent crack spreads, and it's really interesting to see that this trend has held up there. The bigger question is there the actual backdrop where these crack spreads can narrow again. Obviously, you have to hit demand in order to do so, and that recession could happen. But what a trend these crack spreads have had, right?
Well, Patrick, I want to be clear that I am not an expert on refining and the physical market, but from what I've learned about this in the last couple of weeks, it sounds to me like no. The answer is there is no room for crack spreads to come back down or refining margins to come back down, which is what the government is so concerned with. And it's really easy to see what's happened here. The critical thing to understand is that refineries are incredibly big, capital-intensive investments to build. If you want to have more refining capacity, you accomplish that by building new refineries. The payback, because of the massive size of that capital investment, is at least 10 years. So you've got to have a very strong argument that there's going to be payback for at least the next 10 or 15 years, or it just doesn't make any sense for any investor in their right mind to build any new refineries. Now, You then have President Biden take office and essentially declare war on the oil industry as if the oil industry is the enemy of the state. That means that nobody in their right mind would invest in new refineries and building them because this is a zombie industry that the government seems out to put out of business. Then all of a sudden, prices go through the roof, and particularly you see gasoline prices at higher levels for the same price of crude oil. And the government gets all upset and says it must be price gouging by these evil, nasty oil companies. No, what's going on is these oil companies are unable to build new refineries because President Biden's policies have made it essentially uninvestable to build new refineries. I think what this might come to at some point is the government might be forced to subsidize the construction of new refineries if private investors don't want to foot that bill. And of course, it would be next to impossible for Biden to sell that to his constituency based on the fool he's made of himself earlier in his term as president. So I don't see how he could possibly, have a government subsidized program to build new refineries. And thanks to his own policies, I don't see how the industry can justify building new refineries. That means we're stuck with the refining capacity that we've already got, and it's pretty clear that with the capacity that we've already got, well, look at the crack spreads and look at the price of gasoline. What's going to make this better is building new refineries, and there's no recipe for that to happen. But let's move over to junk bonds, Patrick. Now, I want to just qualify this to say you and I have both speculated, I don't know how many times in the history of MacroVoices, that surely, finally, these overpriced junk bonds are rolling over and it's time to short junk, only for us to find out that, no, the market surprised us and they moved higher. Are we finally seeing the big moment where junk is going to collapse?
Well, listen, all bonds collapsed, right? To me, it's all about the relative move. And what I found particularly interesting, like you saw on when we talked about the 10-year yield, how it has meaningfully retraced. And we're seeing, some of these very oversold bond conditions in Treasury have these reactions. But where we have not seen a reaction at all is after that huge breakdown in junk bonds, they remain very weak. And one of the big kind of the secondary canaries in the coal mine that is always a risk factor is when do the credit markets start to price in real credit risk for a lot of these lower tier companies that represent default risk. And what we have here is a junk bond market that's not only accelerated the breakdown here in the month of June, but the bounce has been a dead cat bounce. It's been very weak. And that is most easily reflected by looking on page 12, where we have the high yield credit spreads. And you can see them breaking to fresh highs, now well above 5%, which is continuing to demonstrate some of the most immediate risks. And the fact that we are seeing credit spreads continue to blow out like this is a warning sign that the stock market is not very close to a bottom yet. Usually you see the credit spreads like this have their blow off and the credit markets calm down when you have a more meaningful bottom. The bigger question now is, will we see these credit spreads blow up to 10% or more before we ultimately see the bottom of this recession bear market? And that's certainly something that's going to be on my mind.
Well, I think it's very likely that they will, Patrick, and although you can't see it on this chart, it's not as if a 10% spread is unheard of. We've had that before, and we've had higher than that before. And it seems to me
March 2020 was 10%, so it's not like it was within a year or 2 years that we had that, right?
And there were other times previous to that where we've had that and higher. So it's not like it can't double from here despite how far we've already moved on the high yield spreads. Now, listeners, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading, Patrick's trading service. Details are on page 13, or you can just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at MacroVoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.